Hey, what's up, you guys? It's me again, back with another video. So listen, this video is just about, some terms that you should know in the stock market, because I've been getting some people texting me. They say some words, they would like me to elaborate on some words that I say in my videos, because they're stock market terms. They're these type of terms that people don't use them all the time. So this is just some terms that you should know about the stock market. It's just a short little video, you know what I mean? And comment down below how you doing today. If you found this video, a little bit informative, go ahead and drop a like. That was a car just wilding, but go ahead and drop a like. And like I be saying, listen, ain't no intro for it. I don't have an intro. I'm just gonna say this as my intro all the time, okay? Because that was the first thing that I said, the first video. So that's my intro. Ain't no intro for real. So all right, let's just get straight into this video. So, by the way, all the words I'm gonna be saying right here, I'm gonna put them on the screen, and nice little edit, and it's just gonna say it. So if you invest in the stock market, just some easy words that you should know are these right here. I'm gonna put them right here. Let me see. I'm put them right there. Put them right there. They're just gonna be right there, and throughout the video, I'm just gonna, they're just gonna be there. So the first one is short interest. Short interest on a stock, it tells you how shorted it is. Like AMC right now, I'm pretty sure a lot of people know that, if you're invested in AMC. But for right now, AMC, the short interest goes up and down, you know what I mean? But it tells you how shorted the stock is, which brings me to the next one, which is short. To short a stock means, so you know how Toys R Us, basically, how they went bankrupt. So basically what these hedge funds did, I'm gonna get to hedge funds later, but there's some people called hedge funds, and hedge funds are these people that, these millionaires, they give these hedge funds their money to invest for them. So they have billions at their disposal. They have a lot of money, so they could just buy a stock and it could go up just like that, because it's a lot of capital. Like demand is increasing, and they're buying the stock, so that makes the stock go up. But a lot of these hedge funds, what they do is they short the stock, which means they're trying to bring the stock down. So it's something in options. That means they're betting that the stock is going to go to zero, and they have a lot of money, so it just brings the stock down. And they borrow the shares. So basically what they do, they borrow the shares from the company, and then they put it out in the market. And then when people buy them, basically what they're trying to do, they're trying to have people buy them and sell them. So boom, okay. It's just hard to explain what shorting is, but listen. Imagine that so imagine that one hedge fund organization or whatever, right? They borrowed 1 million. They bought 1 million shares of a stock at $10, right? What they do is, as soon as they get it, they sell it. They put it back into the market. How they make their profit is when the price of that, the price that they bought it at $10, it goes down. If it goes down at $5 now, they could go ahead and rebuy the shares that they bought at $10, I said. So the middle, they're keeping the profits in the middle from 10 to 5. So what they ultimately want to do is bring the stock to zero so they could, you know, maximize their profit. They usually do that when they think that the stock, I mean the company, you know, the business is going to go to zero. When they think that the business is, you know, is just trash, they don't need it anymore, so they fucking, oh, I curse. Damn, YouTube, please don't do that. So they you know, basically they want to bring the stock down to zero. That's what shorting a company is. That was I said it was gonna be a short video, but it's probably gonna be like 10 minutes. Okay, the other one is call and put. These I'm gonna put them together. Call and put. Call is, so this is in options. So options is just you betting that the stock is going to go up or down, or if it's just gonna trade sideways. This is what options is. But options, you borrow. Options, what it is, you borrow the stock for a lower amount of money, for a premium. So like if you want to buy 100 shares, 100 shares in the stock market is one contract. It's one contract. So every 100 shares in options is one contract. So if you buy 5 contracts, that's 500 shares, right? So let's say you think that, you know, AMC is going to $1,000. So you buy a call that the AMC is going to $1,000. Let's say the price for the premium, you know, you're not gonna buy, you know, 100 shares at that $1,000 price, right? I mean, one share at $1,000. You're not gonna buy it like that. It's gonna be lower. It's gonna be at a reduced cost, and you're gonna buy it. And when the stock goes up, let's say it goes past 1,000, you could go ahead and exercise that, which means, you know, like that's when you could exercise that's when you could exercise, you know, these options. When it goes past, like when it's way in the money, that's when you could go ahead and exercise it. And exercising is just you just actually buying the stock instead of just selling the options. So I'm gonna make this video a little bit shorter because I think I have to explain these things and you know, like in every video. But this is just I'm just going to give you guys the, you know, just the simplest things. So the other one is ETF, and ETF is just, you know, a lot of companies in one stock and bonds. That's what an ETF is. It's just a lot of businesses in one, and it's just one stock, and it usually goes up. Like the S&P 500, it has 500 stocks in there, and it always keep going up. That's just what that's what people usually put their money in. If you want to go ahead and invest, and you don't want to take any risk, go ahead and put your money in the S&P 500. It gives like 5 to 10% a year. That's the return on it. Like if you put $10,000, you have 5 to 10% on, you know, back on your money every year. And that's how people, you know, grow their money and stuff like that safely. The other one is margin. That's when you borrow money from your broker. You borrow money, you know, you don't have enough money, so you borrow money so you could invest. But there's something called margin call. There's like if you borrow money and you use it and you buy a stock, when the stock starts, like the stock price starts going down, then you then they give you a margin call, something called margin call, and it's usually like 30%. Like if it goes 30% below the money that they gave you, then they margin call you, and that means you have to pay up right now, because, you know, they don't want to lose their money, so they want to stop it right there, you know, so the stock doesn't just go down and they just lose their money and they can never get it back. So they margin call you. You either have to buy more of the stock, or you have to deposit money in your account so you could go ahead and, you know, keep your margin level up. So you could replace it. From, yeah. And the other two, I think I'm just gonna give 2 more words, maybe 3. So 2 more words is a bear market. Yeah, the actual animal, bear market. And the other one is a bull market, the actual animal, yeah, bull market. A bear market is when like stocks is just, the price is just declining for like a prolonged period of time, you know, like a couple months, like maybe 6 months, stuff like that. Stocks is just excuse me. Stocks is just going down. They're just, you know, the price is just declining. Maybe like you could probably say you know, during COVID-19 we had a bear market because everything was just going down and down and down and down and down. But then it recovered, and then we had a bull market. Everything was going back up. Businesses was going back up. Everything was going back up to where it was, maybe even higher to an all-time high. And all-time high is, you know, all-time high, higher than the past. Yeah. We are 11 minutes. I don't want to keep you guys for too long. Okay, the last one is dividend. Basically, some stocks, you know, some people are investors like this. Some stocks give you dividends. So basically, these stocks, when you buy it, every month it pays you. Every month it pays you. You know what I mean? Every month it pays you. No matter, like, it doesn't matter if the stock was going up. It doesn't matter if the actual stock price was going down. Every month it pays you. So the way people make a lot of money from that is they put a lot of money in the stock, and let's say it's giving you like a 2% dividend yield, right? A 2% from, let's say, $1 million. I'll put the number here. I can't, you know, right? A 2% from $1 million. It's just gonna give you that every month, and it's just gonna keep accumulating. Or I think that 2%, yeah, might be every year or every month, but I know every month that they pay you. Maybe it's different for every stock, but yeah. But that's the video though. There's a lot of stuff that people should know in the stock market, and then, you know, there's crypto and stuff like that, you know, the crypto market. There's a lot of stuff, you know. Just go ahead and do your research. You know, I don't want to take too long in the video, and, you know, yeah, but go ahead and do your research, do your thing, and just, yeah, drop me a like if you learned something new in this video, you know, and I'll see you guys next time. And yeah, be cool, man.